Eli Lilly is down 21% over the last 12 months. Should you buy it? It's down 21% over the past 5 days. It had a drop of more than 10% in a single day. So, since the beginning of this month, it's down quite a bit. Is this an opportunity to buy? Simple answer is no. We're going to take a look at the numbers and we will see how this is just beginning to pop, how this was in a massive bubble, and it's just the downtrend is not even close to the middle, in my opinion. But anyway, we will take a look at the numbers and compare a little bit to Novo Nordisk, which is down more than 60% over the past 12 months. And this is a much better opportunity and a much better company. We have already made that video on Novo Nordisk, but now we're going to analyze mostly Eli Lilly and compare a little bit to Novo Nordisk, because they are the biggest two competitors when it comes to the market of weight loss drugs. That's where the bubble formed. But anyway, let's take a look at the revenue. 10 years ago, it was doing around 20 billion in top line. Now it's doing 53% revenue growth. It's all over the place. I don't like to see this. It's inconsistent. As you can see, 2023, 20% growth. Last year, 32. This year, 37%. But as you can see, it's very inconsistent. For the for this part of the last 10 years, it was up and down a couple of percentage points. Yeah, sure, it's trending up. There is growth here, but it's very inconsistent. And when it's very inconsistent, when it grows a lot, all of a sudden, you can't just say, yeah, that's just going to be here forever. Or that it's going to continue to grow at the same pace that it's been growing, or maybe slowing down a little bit. You cannot take this 36% and say, oh yeah, next year is going to do 30% in the worst case scenario. No, it can do 5%, okay? If it goes from 1% to 20%, it can also go from 20% to 1% as well, if it has fluctuation. And this graph clearly shows crazy fluctuations in growth with some negative years, such as here in 2017, minus 6%. So yeah, keep that in mind. Predictability is very important when you're trying to buy something that is going down in price. And we do not have any type of consistency to the top line revenue growth. Gross margins, let's see what's going on here. 10 years ago, 74%, had some dips, improved to almost 79, and then dipped again. Again, this is not very consistent. Operating margin, growing over time. This is looking a lot better. It had an increase in 2015, going from 18% to around 28%, and it had stayed there for the next following years. And now, with the weight loss drugs coming in, it has improved again, going from 31 to 43% in operating margins. These are very, very good margins, but still lower than Novo Nordisk. So here on the left, we have Novo Nordisk gross margins, 84%. Let's take a look at the graph. 10 years ago, it was 85, so very, very consistent. And Novo Nordisk wasn't a huge mature company back then either, so they both grew at the same time. But as you can see, the consistency and the high margins for Novo Nordisk are across the board. So this company, Novo Nordisk, has hit a market cap of $650 billion, while Eli Lilly was at around 900 billion at some point, and now it's, I think, 600 something. Yeah, 570. Yeah, that's a significant drop. But still, 570 compared to the 220 to Novo Nordisk, it still has a lot of way to go down. Profit margin, again, inconsistent and not so high as Novo Nordisk. Here, the profit margin, you can see on the graph, much more consistent, which is exactly what we want to see when making a buy into a company that has fallen more than 60%. So this hasn't even fallen yet, and yeah, I would definitely not buy it right now, because anything can happen with this company. I do not have any clear signs of getting any high return for this company in the short term, next 12 months, even medium term, 2 or 3 years. So I would definitely try to stay away from something that went up 300% in the past 5 years and is clearly in a bubble. Let's take a look at the balance sheet. Cash and cash equivalents. It used to have more than 7 billion in the short-term cash piles, and now it's sitting at 3.4 billion. So much lower than all-time highs. What else do we have here? Total assets going up over time. Total liabilities going up, maybe a bit slower. No, this is total liabilities. Kind of the same with total assets. Shareholders' equity, all-time high, but yeah, 18 billion compared to a market cap of 570 billion. Yeah, I'm not getting excited about this. Net cash. Yeah, this is not looking good. Negative net cash of $36 billion. They have taken on more and more debt, as you can see. 10 years ago, they were around $8 billion. Even 2022, they were doing a lot better. 16 billion only. They just racked up a lot of debt, and it seems like it just continues to grow. Last 4 years, it had high growth in this debt amounts, $40 billion. Let's take a look at the cash flow and see the operating cash flow. Yeah, $10 billion. Yeah, I don't like this. Trailing 12 months, 10 billion, 11 billion, and they're sitting on a debt of 40 billion. Yeah, I don't like to see this. I just don't like that. This is a red flag for me. From what I remember, Novo Nordisk did not have any significant debt. Total long-term debt, this is Danish kroner, so 87 billion. I'm not sure how much is that in yeah, total debt, let's see, 99. These guys have also, this is like $15 billion in US dollars. So, and they're also paying down a little bit. As you can see, from last year, it's been going down. The net cash also looks ugly, but this is about $10 billion negative. But Novo Nordisk has a lot higher margins and a lot higher profitability and a lot lower stock-based compensation, which is something to also take into account. So net income 13 billion, 14 billion for Eli Lilly, and stock-based compensation is 600 million. It's very hard to compare the gross numbers because this is in Danish kroner, so we can only compare as a percentage of the net income. So 2.3 billion DKK to 111 billion DKK in net income. So as you can see, the percentages are extreme. It's basically nothing. The stock-based compensation for Novo Nordisk is nothing, while for Eli Lilly is, I would say, 4% here compared to the net income. But still, it's low. It's okay. This is a type of company that I could buy and own. This isn't a huge red flag, but it's just worse than Novo Nordisk. I'm not saying that Eli Lilly is a bad company. I'm just saying that right now, buying Eli Lilly compared to Novo Nordisk is definitely not a good idea. Novo Nordisk is a much better option. Let's see here. Repurchases of common stock. And actually, Eli Lilly pays a dividend. They're paying 5 billion in dividends compared to a market cap of 570 billion. That's not that much. It's less than 1%. So repurchases of common stock, trailing 12 months, again, less than 1%. Yeah, I mean, the market cap is just too big. The stats are fine. They're doing all the right things. They haven't been a habitual buybacker of shares, but they have shown in the past that they can pour money into buybacks when they feel like their shares are undervalued or they have excess cash on hand. So they had that huge cash pile in 2017. They poured it into buybacks, it seems. So that's good. Yeah, the only problem is valuation. Let's take a look at the ratios for the valuation. So let's take a look at the market cap history. Yeah, 10 years ago, on less than $100 billion, hovering around 80, 70, 90. And then it got up to a market cap of 800, but I think during this quarter, it actually went up to 900. So yeah, it's still ways to go. 570, the bubble just popped. I think we're gonna see some more blood coming soon. PE ratio 41, still extremely very rich valuation. PE ratio for Novo Nordisk is 12, which is dirt cheap. So you're getting a much better company in all metrics. All of the fundamentals are looking much better for Novo Nordisk. Even growth is more consistent and better. Yeah, Eli Lilly, not the same high quality company, trading at a very high multiple of 41. So almost 4 times more. You're paying 4 times more for Eli Lilly right now. Forward P 23. Forward P for it's not showing here, but I think it was 12. It showed here forward P 13. Yeah, so what are we talking about? Much cheaper than Eli Lilly right now. Well, of course it is, because it dropped more than 60% from all-time high. So the opportunity is clearly in Novo Nordisk. EV to EBITDA, 24 times. EV to EBITDA for under 10. This is amazing. and 10-year low, decade low valuation. Let's take a look at some other profitability metrics. Return on capital invested for Eli Lilly, it's 28%, going up over time. 10 years ago, it was at 10%. Now it's 28%, and it has been trending up. Great. This is exactly what you want to see when you buy it and want to own a company long term. Same with ROCE, return on capital employed. Again, trending up, 37%, very high number. It's very nice to see. But as you can see here, Novo Nordisk, it's been trending down, but it's still up 42%. Also, the ROC has been trending down over time, but it's still more than 50%. So if I seen these type of numbers 10 years ago, I would definitely say, okay, time to buy Novo Nordisk. Looking at the stock price, let's see here, Novo Nordisk. I think it was flatlining for quite a while. Yeah, 2015, as you can see here. Let's take a look. Yeah, it was flatlining for more than 5 years. You had a lot of opportunity to buy this, especially 2016. It dropped by a lot. It dropped almost 40%, more than 40%. So that was a huge opportunity for you to buy when looking at these numbers. I mean, 91, 97% return on capital employed, and every other metric was looking pretty amazing. FCF yield, 4.5%. Not getting super excited, but I think this is a very attractive when compared to the S&P, because all other metrics are a lot better, almost double the S&P average, and you're getting it much cheaper than the market. FCF yield for Eli Lilly, less than 1% right now. It's ridiculous. I mean, this is just gonna drop further, and I mean, it's gonna go down a lot more from here. Yeah, I don't see how this is sustainable. It was in a massive bubble. Look at this, 0.15% of free cash flow. That was insane. If you own this, or if you bought this in 2023, you would have made a huge mistake, in my opinion. Let's see the price to earnings back then. Yeah, 100. Yikes. Let's take a look at the price. 2023. It has gone up a lot. So if you took a lot of profits, if you had this and if you held it and took a lot of profits, that would have been perfect. But if you bought around this area after the big rally, late 2023, 2024, I mean, you're already down money since early 2024. So yeah, this is a problem when you're buying into bubbles and companies that have had a very good run and have gone up in price a lot. Your risk goes up tremendously. Remember, guys, Seth Klarman, margin of safety. You do not want to be buying these extremely expensive bubble stocks. Stay away. Opportunity is when the company goes down by a lot. This is when you buy when it's low. Again, let's take a look at it's hard to see, but if I could zoom in on this, maybe I will pause and come with a different graph. Okay, so here we are with a graph on ticker.com. Novo Nordisk share price. Starting late 2014. As you can see here, the price was 28, 29 for almost a year. Let's just say a little bit more than a year. It crashed down by 40%, hovered around this area for a while, and this was a great opportunity to buy Novo Nordisk, and it continued to go up since then. You would have had some massive gains. Just buy low and hold and take profits along the way. You don't know exactly where it's going to go. You cannot predict how high or how much it's going to grow, but there's one sure thing. If you buy low, something that's not going to go bankrupt anytime soon, you're getting a high quality company for a good price, then you're going to make money on it. That's just the way it is. And yeah, along the way, you're going to take some profits. Maybe you don't want to sell out completely unless something changes, unless it gets into a ridiculous bubble like this. Because you're not missing anything when the company has a massive, crazy run, almost tripling in market cap in less than 4 years. Because guess what? That means it's just going to be in a bubble. And when bubbles pop, they violently go down. And they create some massive opportunities. So yeah, never regret selling. Let's say your investment has doubled in less than 12 months. Let's say you had it around here, you still held it, it was 5% of your portfolio, and it got up to 100. It would not be a bad idea to just sell out completely right here, even though the price still went up by 40% more. Because guess what? When the bubble forms and then it pops, look what happens. It's always the case. The markets never goes just straight up, and companies grow into that bubble valuation. Eventually, the growth stops or slows down. Eventually, there's a new player, some new competition, and the bubble is just gonna stop, and it's just gonna drop violently, and then you can get back in. You can get back in at a much cheaper price. So that's how you make money when investing in individual stocks. That's how you outperform the market. You have to buy and sell. You have to buy low, sell high, take profits, and then buy low again. You don't have to buy low the exact same company. Maybe you have some other opportunity, but whenever you invest outside of the S&P 500, that's basically what you have to do. That's what everyone has ever done in the history of making money in the stock market. Buying low and making profits. Nobody has made a lot of money just buying high, speculating, and selling right after. That's a very, very risky move, which I've never seen it work. I've never seen anyone just say, oh yeah, Palantir. Let's just buy into Palantir right now. After it's gone up 2,000% in the past 5 years, 2,500%. I don't think any good investor will ever look at this and say, yeah, now we're going to make some money. Now we're going to buy into it. It's just so stupid. Yeah, so buy low, sell high. That's how you make money.